Good morning. So we're, I just would like to, as we are splitting the presentation, I'll just provide you with the motivation for the research itself, right? So subsequently, you'll see an overview of the model, the numerical illustration, and discussion of outcomes until we then take your questions. So starting with the motivation, we generally have an understanding of how households and how the economy as a whole reacts to interest rates hikes, etc. We have a general understanding of consumption behavior in face of interest rates hikes. What recent research has aimed to do is trying to understand it in a more granulated fashion, to get a snapshot of how different households behave when faced with an interest rate hike, how their consumption, how their spending is affected by that. And different research, for instance, the Federal Reserve of San Francisco, in a very recent economic letter, had this short evaluation of how households divided basically by gender and race, 4 groups of Black women, Black men, white women, and white men. And these are people heading the households, how they would, in a 3-year span, have react to a 1% 1 percentage point increase in interest rates. And they came up with the conclusion that households headed by white women would have would be the most responsive group to such interest rate hike. And you know, in general, we also know that there is a historical trend, right? At least in the last 20 years, we can see this clearly, where total household debt has been increasing. You have, you know, differences here. Once you divide this debt into credit card, auto loans, etc., they'll behave slightly different. But in general, the total, which you see here as this line, has just a general increase in the last 20 years. So if we go further and we try to separate this debt, to try to analyze it, taking into account not only the type of debt, but also income levels, we also see certain trends. And what starts to come up in these trends is that, especially when you look at something like this, women are generally at a more disadvantaged position in different types of markets, including, for instance, and especially in the housing market. Further, this specific graphic is quite interesting because when it comes to the position of women within different wealth brackets, right, we see that there's actually a specific group where they are above 80%, those who have wealth between minus 0.009 K to minus 12.4 thousand, negative wealth, or if you want to just call it that, right? So this led us to think of how is it that this can be articulated in a given framework, taking into account demand-led growth and other frameworks of analysis in post-Keynesian economics. And I'll let Joana take it from here.
Right. So yeah, just given this motivation, can you all hear me well? Okay. So that's right. What we were thinking about is, you know, trying to incorporate these differences that we observe in terms of gender inequalities within accumulation of a household debt. So trying to incorporate this into a type of demand-led growth model. And specifically, what we are trying to use in terms of an approach, right, is following a super multiplier model. But what we're actually thinking about within the super multiplier model is a model where we have the sort of semi-autonomous component of demands, like the household credit finance consumption. We take it to be semi-autonomous from current income. And so this would be sort of the component here that drives growth, right? So deriving a little bit from a paper that I've recently written with Lydia Brochet. But then what we also wanted to do is incorporate in this model a household sector division that would account for this difference within households. So here following a recent paper by Hanna Simborska. And given this framework, then we wanted to look into how monetary policy, and here we're going to be understanding monetary policy as an increase in the federal funds rate. So we're going to be calling it RCB, right? The interest rate influenced by the central bank, and then how this is going to affect our demand-led growth model, but specifically how we can actually understand changes in inequality through especially consumption ratios between these household sectors and income ratios between these household sectors within this model. So then let's actually start presenting the model. So this is how income distribution is defined in our model. So first of all, we have three household sectors, right? We have the workers, right, which would we understand as sort of the low income households. They do receive wages, just like the middle class, but the idea here is that they are receiving a hourly wage, right? Or the middle class is receiving an hourly wage that is higher, right? Because alpha one is going to be bigger than one. So the middle class is paid for hourly wage at a higher rate, but they work less hours, the middle class. And so this then defines the income distribution in terms of wages between the workers versus the middle class. Also following a little bit some contributions from Satterfield and Kim, where they also suggest this division between different workers within the household sector receiving wages and working hours. Then the other differentiation that we have is that the low income class is going to be paying rent, right? To show that idea that, you know, low income workers, they can't really afford mortgages. Just the middle class does own houses and owns it through financing it through mortgages, and then renters, they are just able to buy houses on their own. However, our low income workers are the ones who are going to be actually taking out personal loans, so credit card, in order to actually consume, right? And then finally, renters are the ones receiving profits. They also receive rents from the working households, and they just own houses. They don't need to finance it through mortgages. And so this is what our stock flow consistency, our transaction flow matrix is going to look like, right? So we have three household sectors, we have firms, and then we have commercial banks. And what we are going to have is that commercial banks are going to be sort of defining three types of interest rate: an interest rate that they charge on low income workers that are getting loans through credit cards, a interest rate that they charge on mortgages that we're going to assume that has a spread that is lower than the spread that they charge on credit cards, and then an interest rate that they charge on firms, which we're going to assume that is actually going to be very similar to just the interest rate that the central bank is defining. Right? Even though the central bank doesn't appear here, the role that the central bank is going to have is to define the RCB, right, the interest rate of the central bank, which will then highly influence the interest rate practice by this commercial banks. But otherwise, you know, it's just the definitions that I was talking about in terms of housing and consumption for all of these workers. So then taking a little bit of a further look into this model, right, especially into the workers' consumption, because this is really the behavior that we wanted to look at, especially because it's something kind of new that we have been recently working with, which is this idea then that we have within this working household sector, this growth of household debt being driven by this semi-autonomous function. So the idea here is then that working households are consuming partially from their income, but they have a part of their consumption that is coming from loans, so from credit cards, and then the rate of growth of this exogenous component, right? Well, it's semi-autonomous component has an exogenous component, and this is sort of somewhat historically determined, path dependent. So there's this idea that there's a certain consumption target that households have that is sort of historically determined, but because of the ways income distribution has been evolving historically, they haven't been able to fulfill this consumption target. And so they've been having to get into debt in order to actually achieve it. And then, but however, right, they are also somehow somewhat responding to a certain debt burden. So the idea is that this DS is representing the debt burden, right? Because if they're getting into debt, they are going to have to service their debt. And so this imposes a debt burden in their income, which then the higher is the debt burden, of course, right? The less likely they are of taking even more loans out. So it's a semi-autonomous component here of demand. And then finally, we're also assuming that these workers are going to be paying rent, and that this rent is just going to be a fixed proportion of the wages that they get. Just the wages, the wage bill that they have. Okay. And then in terms of the two other household sectors, we have the middle class, and we're going to be assuming that this middle class is going to be consuming out of their income. They also are allowed to take out some loans in order to finance housing. But here we're going to be assuming, at least for this first presentation of our model, right, this is a working in progress. And so we are, we are considering actually the possibility of also thinking of this as a semi-autonomous component, because we do understand that, the whole concept of residential investment and how much is it actually fully endogenous and how much is partially autonomous. But for now, we also, for simplicity of this first presentation, we decided to just keep it fully endogenous and determined by the wages of the middle class. And then finally, rentiers are just consuming out of the income that they get, which is the profits of the firms, the profits that are coming from commercial banks, and then the rents that they are charging the working class. And then in terms of the firm, we're just assuming the usual supermultiplier investment function, as defined by Freitas and Serrano. We're also going to be allowing for firms to take out loans, right? Ventures, they don't take out loans. If they do, it's going to be through the firms. And then so they finance part of their investment through new loans, and then a part of it through the issuance of new stocks. But then what really matters for us here is actually looking at what is going to happen within commercial banks. So we're going to be assuming that they're not going to be paying, just to simplify our analysis here, that central commercial banks, are not going to be paying any interest rates on deposits. They do charge different interest rates, right, to the working class. The idea here is that there is the interest rate on credit cards. And so there's a spread, we're going to call it S0. And then there's also a spread on the interest rate being charged on mortgages. And, of course, we're going to be assuming that this S0 is going to be larger than S1 because, well, the spread is much higher on credit cards than on mortgages. So this is this is where there's going to be a lot of variables, and I'm sorry about this. I tried to make it as least math as possible, but sorry, but yeah. So I'll try to explain as much as I can all of these variables, but they are important because they're going to be appearing, of course, in the interpretation of our results. So yeah, in terms of a short-run equilibrium, right, we know that this is going to depend, right? This is going to define our rate of capacity utilization in the short run, and it's going to be dependent then on the GL, which is going to be the rate of growth of workers' loans. Then we are also going to be depending by our short run and our long run equilibrium on these three ratios, which are very important, which is the ratios of each of the two households' loans and the firm's loans over the capital stock, which are also ratios that are going to be appearing quite a lot in our model. How am I doing on time? I know I talk fast. Oh, I can. Okay, so I have a lot of time, so I can. Okay. Okay, thank you. Yeah, I want to make sure that I get the time to say everything. So, right. And so in terms then of the steady state equilibrium, as expected, right, this is going to depend on the variables that we had just defined here. Just like the short run equilibrium, the long run steady state equilibrium also is going to be dependent on these variables. So once again, the rate of growth of workers' consumption, which is going to be because of the way that super multiplier models work is going to be defining the rate of growth of our economy here. Also the investment per income ratio, and then the two sort of loans over capital ratio as well are going to be quite important. And I just wanted to sort of open a parenthesis here to say that we have already sort of published a simpler version of this model. Well, we haven't published, we've already come out with a paper that has a simpler version of this model that does show that we can arrive at an analytical solution for this model, and that this analytical solution is stable. But here, because of these additions that we are making into the model, adding household sectors, allowing these household sectors to get into that, as well as firms to get into that, the analytical solution has just become a bit too confusing and impossible to interpret. And so we'll just skip that part and then just go into a numerical illustration, which we thought would provide much more clearance about, what our model is actually trying to show. So this is then our steady state solution. And this is the steady state dynamics that we're going to be doing the numerical simulations on, right? And just because of the way that the long run steady state equilibrium works, right? The variables that are going to be determining our steady state dynamics are going to be the same ones that appear. So the rate of growth of working households, the rate of growth of the loans, the total stock of debt of working households, as well as the loans ratios, and then the investment per income as well ratio. So depending on these variables. But what I actually wanted to especially investigate in this model is, of course, the whole aspect of the effect, right, that monetary policy is going to have on inequality. And so for that, what we did is actually look at a few specific income as well as consumption ratio. So we ended up finding a sort of a literature that discusses that, there's a lot beyond just looking at income inequality, and that consumption inequality can actually also tell us a lot about the inequalities that we are observing. And just because of the way that this model is built, that we are thinking about this consumption or debt-driven consumption as the main driver of growth here, we thought that looking at consumption inequality would be an interesting aspect for us to study the effects that monetary policy is having on income distribution. So here, then once we derive the steady state, or we look at the numerical illustration for the steady state, then we're going to be looking at a few ratios that we have defined to be important. So the consumption of the working households over the consumption of the middle class. So we want to see how is this going to be reacting to monetary policy, the consumption of the working class over the rentier's class as well. So we want to see how that consumption ratio is also reacting, and then the middle class, the consumption of the middle class over the rentier's class, and then some other income ratios. So the income of the working over the total income, the total GDP, and then finally the workers to the middle class income ratio also we're going to be exploring, but we're going to mostly be focusing actually on what is happening to the consumption ratios between our different classes of household sector. And this is what their analytical solution looks like. It doesn't tell us much, but with the numerical illustrations, I think it's going to tell us a little bit more about the informations. I also had put here the dynamic equations, but I don't think I can actually, I don't know how to click on this thing. It's okay, it doesn't matter. It's just a bunch of math. Yes, but it was just a bunch of math anyway, so which wouldn't really, I think, add anything to the presentation. So I'll just skip that part and move directly then to the numerical illustration, which I actually think that showed some interesting results that, or at least preliminary results that we wanted to discuss today. So in terms of the parameter values, well, we're going to start with an interest rate practiced by the central bank of 1%. And we're also going to be changing a little bit the spread, right? The idea here is that when commercial banks realize that the central bank is increasing its target for the federal funds rate, they might actually be able to even increase the spread themselves a little bit. And so we want to see the effect that this is going to have on our consumption ratios here. So, well, first of all, this is just to show that there's steady state stability of our model. So we start actually with a model without yet putting mortgages into the model. And then we want to see the effect that this is going to have. And I just wanted to emphasize something, because this is going to be essential to understanding a lot of the results that we're going to have down the line, which is we only have one driver of growth in our model, which is the rate of growth of households, working households debt. So that a lot of the effects that we're going to be observing, everything that the monetary policy is going to be, in every way that the monetary policy affects the economy as a whole, passes through GL, the rate of growth of the working households. And if you remember, right, this ratio, well, this rate of growth, we said that was negatively affected by the debt burden. So of course, that when I increase the interest rate, the debt burden increases, so that this rate of growth is going to be decreasing, and therefore bringing less growth, economic growth to our model. And this effect is going to be very strong, because this is a super multiplier model where the only component of exogenous growth that we have, or semi-autonomous growth, is our GL. So the rate of growth of the working households. And in our simulations, right, this GL has to be high, because otherwise we don't really have a lot of space to actually change the parameters for our model, just because of it's still a quite simple model. And one of the things that we are thinking about in terms of future work is actually expanding the model and incorporating other sectors, but we haven't done this yet for this paper. Right, so here is what happens when we actually incorporate middle class mortgages into our model. So right, before middle class were not getting into mortgages, so they were not getting any houses. And here now they started to actually get into this loan market, and the effect that this has is to actually increase. So I need a higher rate of growth of working debt so a higher rate of growth of the debt of the working class, in order to be able to incorporate the middle class getting into loan. And the effect that this higher growth rate has in the economy is to actually lower my workers' loans to capital or GDP, really, because, you know, once again, it's a super multiplier model where the GL is the driver of growth, so that the effect that this has on the economy. So even though the amount, right, the stock of working households that is increasing, because, you know, we see that GL is increasing, the effect that this ends up having in the economy is to increase even more GDP and the capital stock, so that the actual ratio of working household debt over capital stock decreases because of this result. And this is actually a result that we're going to be seeing quite a lot in our model. So I just wanted to use this to emphasize it at this point, because it's a feature of the model that will just really explain a lot of the results that we get. So given then this framework, now with the households, with the middle class being allowed to get into mortgages in order to buy houses, so we look at the effect that it's going to have of a small increase in the interest rate of the central bank, so the target for the federal funds rate. And here we're just increasing it from 1% to 1.25%, so just like the 25 BPS increase that we have been seeing. And we look then at the effects that this is going to have on some of our ratios. And as expected, this small increase does have an effect in decreasing the total, right, the rate of growth of the stock of households' debt, of the working households' debt, and increasing the ratio of households' debt, working households' debt over the capital stock, right? One thing that is also expected is that the ratio of working households' income to total income also decreases, showing that then these working households are getting sort of a smaller share of the GDP. However, the consumption ratio, which was something that we were quite interested in looking at, which is the consumption ratio of working households over rentier households, increases. That was not a result that we were quite expecting, but it just kind of makes sense because if, I have a decrease once again in my GL, because the higher is the interest rate, the higher is the debt burden. So the less these working households are willing to get into debt, this has an effect on GDP, on less growth. And then this is what we are observing then. Rentiers households are also consuming less, right? Adjusting then to this lower GDP that the economy as a whole is getting. And this is why we observe that increase. Now, if we do increase the interest rate a little bit more, so as opposed to a small increase in the interest rate, now we're talking a bit about a bigger increase in the interest rate from 1% to 2%, then you start observing results that might be a little bit more interesting. So once again, of course, we have to have this decrease in working households debt, which also reflects then this increase in the ratio of working households over the capital stock. But now what we observe is that the effect that this has on working consumptions start becoming bigger than the effect that it has on rentiers consumption. So that was the first result that we had. So now what we have is that the effect that it has on GDP, right? The decrease in capital, the decrease in GDP growth because of the decrease in the growth of working households that no longer compensates. And so we have actually a decrease in the ratio of working households consumption over rentiers consumption. And then what we also wanted to look was changes in the model. If SO is the spread that commercial banks the spread that commercial banks charge over the central bank's ratio in terms of credit cards. And what we see then is that this result for the working class over the rentier class becomes even more clear and stronger. So then increasing the inequality of consumption between working households and rentiers households. One thing that we don't observe is an increase in inequality between working households and the middle class. And once again, the reason is because of this effect that the decrease in the rate of growth of working households that has on overall on the economy overall, which then in this case is not going to be compensating, right? So we actually don't have an increase in inequality between working households and the middle class. However, we do have an increase in inequality between the working households versus the rentiers households, and an increase in inequality between the middle class versus the rentier class. Okay, so just really, and this is still like a preliminary result. One thing that we were thinking about is perhaps incorporating a little bit of a semi-autonomous residential investment in our model, because then we would have another driver of growth in our model, and then we would be able to see a little bit better this increasing inequality between working households versus middle class. However, already with this result, right, we are seeing that the monetary policy has an effect on consumption, and it affects different household sectors differently, right? Even if we are assuming that the way that the monetary policy is sort of generating a recession, and this recession is somehow affecting everyone equally, even because we do have a model, right, because the decrease in the capital stock is the same for everyone, but still the increase on interest rates affecting the consumption of these working households who are so dependent on credit cards and personal loans in order to consume is actually aggravating the inequality, especially the inequality between the rentiers class, which perhaps, we would be associating more with, gender and racial disparities in terms of the rentiers class being the white men, and then the other classes, especially the middle class and the working class, incorporating a little bit more households who are headed by white women. But we do realize that, there's some still limitations of this model that we're working on, and, we are gonna, of course, welcome all sorts of comments in ways that you think we can improve this sort of first analysis. Okay, thank you. I think that's it.